How do bonds work? We're diving into the world of bonds. Bonds are a fundamental part of the investment landscape, but they can be a bit confusing for beginners. I'll explain how bonds work and why people buy them. Introduction to bonds. A bond is a loan made by an investor to a borrower, typically a corporation or government. When you buy a bond, you're essentially lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value when it matures. So how do bonds work? When you buy bonds, you agree to lend money for a specified period, maturity. During this time, the issuer pays you interest known as the coupon, usually on a semi-annual or annual basis. When the bond matures, the issuer pays the principal back, par value, to you. So let's talk about types of bonds. Government bonds. Government bonds are issued by national governments like the US Treasury bonds. Corporate bonds issued by companies to raise capital. And municipal bonds issued by states, cities, or other local government entities. So why do people buy bonds? First, for stable income. Bonds provide regular interest payments, which can be a reliable source of income, especially for retirees or those seeking steady cash flow. Capital preservation. Bonds are generally considered less risky than stocks. If held to maturity, you get back the principal amount, making them a good option for preserving capital. Diversification. Including bonds in your investment portfolio can help diversify your assets and reduce overall risk. Bonds often perform differently from stocks, so when the stock market is volatile, bonds can provide stability. Lower volatility. Bonds tend to be less volatile than stocks. Their prices don't fluctuate as wildly, which can be reassuring during turbulent market periods. Tax benefits. Some bonds, like municipal bonds, offer tax advantages. The interest earned on municipal bonds is often exempt from federal income tax and, in some cases, state and local taxes. But there are some risk factors. First is interest risk rate. When interest rates rise, bond prices usually fall. If you need to sell a bond before it matures, you could incur a loss. Credit risk. Credit risk is the risk that the bond issuer might default on its payments. Government bonds generally have lower credit risk compared to corporate bonds. Inflation risk. Inflation can erode the purchasing power of the fixed interest payments you receive from bonds. So how to buy bonds? First, directly from issuer. You can buy government bonds directly from the government through their websites. Or from their broker. You can buy bonds on the secondary market through a brokerage account. Or through bond funds. Another option is to invest in mutual bond funds or ETFs, which pull money from many investors to buy a diversified portfolio of bonds. Bonds can be a valuable addition to your investment strategy, offering stability, income, and diversification. Invest wisely, and as always, take care of your money.